Hello, good morning and good afternoon to each and every one of you who have joined us. We welcome you all for joining us today for our MasterClass, Integrated Order to Cash Transformation for Global Shared Service Organizations. And we are going to begin over here shortly. Before we begin, I have a request to please mute your audio during the session. And if you have any questions during the masterclass, so you can post them to the host on the WebEx chat, and we will respond to those questions at the end of the presentation. Uh, Joining us today with us, our speaker, John Salick, is the president of Revenue Management Associates, an account receivables and order to cash consulting company. John has over 32 years of consulting experience with proven performance in the order to cash process and has worked in a broad range of industries with over 250 clients. Prior to his consulting career, John has spent 10 years in finance with International Paper and with a medical equipment company. With this, I'm going to have John begin the masterclass to take over the agenda first and begin the session for us today. Thank you. John, over to you.
Thank you, Akshay, and welcome everyone. Happy to have the opportunity today to discuss what I think is a very intriguing subject. And their mission and their challenges. So when we look at the agenda very quickly, we're going to look at what I call their delivery imperatives. There's a lot of pressure on shared service organizations for performance. And we'll talk about some of the capabilities and competencies needed, but then also explore where the next big source of improvement comes from. We'll share a case study with you and then recap the benefits with a quick conclusion and then answer any questions. So feel free to pose questions as we go. If we just take a step back and look at shared service organizations at the 50,000 foot level. Remember, they were created to provide services better and cheaper than they would ordinarily be done in a decentralized environment at each individual division or component of a company. And as such, their performance is the performance demanded of them is very rigorous and it's monitored very, very closely. And certainly for third-party firms, sustained failure to meet performance thresholds can result in financial penalties, recapture of some of the fee that's paid. So there's a lot of pressure on SSOs. And so, how do they meet those challenges? Well, again, at a high level, it's that optimal mix of process, metrics, technology, and a few other things that helps them fulfill their mission. Let's talk about what I call the delivery imperatives, because they're really under the gun. There's a lot of pressure on SSOs to deliver. And, it's kind of ironic in some respects. The first one I call an existential challenge. Now, this is an order to cash webinar, not a philosophy 101 class. But really, when you think about why they were created and why they exist, it's to deliver performance. And the ironic part about it is the operating divisions who have moved the performance of those operations into the shared service organization are often much more demanding of the SSO than they ever were of their own internal operations. But, they're the internal customers and their wishes and concerns cannot be ignored. And a lot of the divisions, in my experience, still would rather to have some of these operations in their own divisions. As a control issue, economically, that doesn't make sense. But every SSO has service level agreements, SLAs, and they escalate every year, meaning the performance requirement increases every year. A lot of them are very elaborate when you read them. Those SLAs are detailed. And again, as I mentioned earlier, the shortfalls are punished one way or another. whether it's a house SSO or a third party. And their other big imperative is what I call the productivity annuity. And what is that? Well, every year they need to increase their productivity, reduce the resources, or handle more volume with existing resources. And generally there's an effectiveness expectation as well. So if the management of accounts receivable in 2019, they were able to maintain a day sales outstanding of 52 days, the SLA for 2020 might be 50 days or 51 days or 49 days. And if they had 28 collectors in 2019, the expectation might be that they have 26 or 27 in the next year and still achieve a lower DSO. So that's a fact of life, and it is an imperative. And you really, the pressure's on, they can't stay the same. They got to always be moving forward. And then also a key challenge is, in theory, they have to accommodate all the divisions and business models within the company. And, you know, most big companies are making acquisitions almost every year, maybe a few, maybe a lot. But the pressure's on to the operations, and we're talking specifically about order to cash operations of those new acquisitions. And as you can imagine, in many cases, there's a huge variation in their businesses, the revenue streams, the business models, the ERP system, which presents its own set of challenges. So life for an SSO is not easy by any means. And there's very, very significant challenges that they face. So to meet those challenges, what competencies are needed? Well, there's probably no surprises here. You know, first of all, starts with a policy, you know, documented policies that everybody agrees to. It's nice if the exception protocols are defined pretty well. And it's nice if the policies are what I would call work reduction policies. Here's an example. If you're in an industry where your customers take a lot of deductions, you can have a policy whereby you negotiate an allowance with those customers for the normal frequency of shortages and damaged goods that arrive. So let's say it's 0.4% of sales. So that 0.4 discount is given on each and every invoice. In return, the customer agrees not to take all these hundreds, thousands of deductions, which creates a tremendous workload. And you know, that's an example of a work reduction policy. Process, best practice process. Easy to say, you know, not so easy to implement. The right metrics, strong analytics, because that's the source of many improvements. And then, of course, governance, which in my experience can be an interesting exercise. But these are the elements that provide the foundation for success. Easy to list them on one PowerPoint slide, much more difficult to establish them, achieve them, and maintain them. So that brings us to the next topic here that we at Emagia call incremental versus exponential. And I think the names kind of suggest the message here. You know, incremental improvements suffice for the short term, particularly for a newly integrated operation. You bring in a new division. Initially, there's a drop in performance. It's kind of inevitable. But then once it's stabilized, you hope to equal the performance pre-consolidation, and then over time to improve it. So a small increment improvement in the first year or two, generally welcomed, but then that wears out pretty soon. And you know, the expectation for an SSO is sustained year after year improvements of very high value. You know, 1 or 2% doesn't always satisfy management. And inevitably, there will be some sub-processes where you won't be able to get huge improvements in productivity or effectiveness for a variety of reasons. One might be it's already operating very, very well. So where's the improvement going to come from? And then others may be business models that certain divisions have, investments required and it's not made. So there are limitations. But if you're managing 7 or 8 OTC sub-processes in a shared service organization, there may be 2 or 3 that are pretty operating near peak effectiveness and efficiencies. So future improvements are going to be limited. So that puts the pressure on making large or exponential improvements in the 3 or 4 sub-processes where there's room for improvement. And in our opinion, exponential improvements aren't really feasible without technology, specifically what we call digital automation. And let's explore where digital automation is required in a shared service organization to enable that organization to make leaps forward. Let's and here's the areas we're going to look at. We'll take them one by one quickly. First one is what we call digital AR portfolio monitoring. What do we mean by that? Well, initially, it's having a consolidated view of the receivables. Because remember, the shared service organization is the caretaker of the company's AR asset. And it's almost a fiduciary duty. So you need to be able to look at the whole asset, not sure what's happening here, and view it in totality and also have totals by customer available to you. You know, quick story, had a client years ago that sold to retail chains and a medium-sized retail chain went bankrupt. And the CEO asked, well, how much did they owe us? At the end of the day, the answer came back from the CFO is, well, we'll know that in 2 or 3 days, which is a terrible answer. And it's because they didn't have this consolidated view of receivables. And that enables so many good things. Optimal allocation of the portfolio amount on your limited collectors, and just having that information for analytics and control purposes is a big step forward. The next sub-process where digital automation makes a huge difference is credit risk management. Particularly important now in this pandemic economy when a much greater portion of customers are high risk and the risk of bad debt is much higher than it used to be. So the workload is probably going to triple in the credit risk management function because you've got to update all your credit limits. You got to monitor them closely. You have to be very aware of changes which are happening very rapidly. And this is where the online tools and the digital automation come in so handy. First of all, online credit app with a digital signature. So your customers can access it and submit it. Second is credit scoring, automated credit scoring. Import the data from the credit bureaus, import the payment history, and you have the raw material you need to do a credit score. Then, with automated artificial intelligence, you can take it a step further and actually have the AI suggest and assign a credit limit. Certainly, you can always review those, but certainly for the smaller credit limits where the risk is low, you can just kind of go with the AI product. And then, of course, a full-featured approval workflow for those credit limits that need approval. And then this last point, especially important in this economy. What we're saying is companies are dealing with half their customers on an order-to-order basis, meaning we don't release this order until we get some payment for the last one. And that's a very labor-intensive process and very requires quick turnaround, and again, to have this powered by digital automation is huge. Same thing goes with collections. In this economy, the collection workload is going to increase tremendous. You're going to be calling customers you didn't have to call in the past. You're going to be making many more order by order basis. So here, automation is absolutely essential to avoid headcount increase, much less achieve productivity. And this allows a collection strategy that you can design to your specifications based on more than one parameter. Gives the collector a prioritized task list. This way, when they check in the morning, they've got their list all set for them. Collector workbench, which gives them everything they need at their fingertips. And then, automated dunning. A lot of people say, well, most of those emails, they just get thrown out or deleted. What good do they do? Well, part of that's true, but for your small accounts, the choice is an automated email or no contact. And given that choice, some contact is always better than no contact. Cash application. This is a sub-process where you can cut out 80 to 85% of manual work through digital automation powered by AI. Remember, we talked about some sub-processes where you weren't going to be able to get much improvement, and others where you can get exponential improvement. Well, this is certainly one of them. And, the AI digital assistant basically does everything that a Cash App team member would do. And in terms of extracting remittance data from a variety of sources and formats, inputting it into the auto cash engine, and we've seen hit rates in the 85 to 90% rate. Automatic creation of deductions, which get routed for resolution, which is great, so they don't just sit there. And the digital assistant can engage with customers to help them make payments via various modes, which certainly helps the customer service. But it's a big one. Deduction dispute resolution, same thing. Your AI-powered digital assistant can visit your customers' vendor portals and identify the deductions to be taken and the reason code, and then route them to the folks in your organization who are assigned the task of researching and resolving them. And again, the full workflow to route deduction, track them through the process, status reporting, where are they, how old are they, automatic credit to debit matching. Again, if you have to do that manually, that can be very time consuming and often gets put off, makes for a messy portfolio. The deduction capabilities also include some nice analytics for diving into root causes, which fuel improvement efforts. Big labor saver is an EIPP portal, electronic invoice presentment and payment. Enables your customers to go to the portal, get the invoice, pay the invoice, input the remit data, register a dispute, all the information they need about their account, get an invoice copy. Can do that from various modes, accommodate mobile modes. And, at the bottom, it's actually pretty mercenary here. We talk about saving your labor. Well, what a portal does is it basically substitutes your customer's labor for your labor. And that's where the savings come in. Plus, a lot of customers request this. They want this. They want that access 24/7, particularly in the small to medium-sized business range. A lot of them do their payables after hours, so to speak. So they need that access and capability. And then the last key capability here comes to analytics. This is what fuels process and improvement and fuels some very big productivity leaps. The example I give here on exponential improvement, 99% invoice accuracy. We had a client that worked over time to improve the invoicing accuracy. And when it got to 99%, you'd be surprised how much of the AR problems and AR work just melts away, just gone. All of a sudden, as much past due, you're not having as many disputes and deductions. The Cash App goes better, accurate invoice, paid properly, boom, gets matched and go. So the analytics are very important to fuel improvements. And also we mentioned at the beginning, remember the shared service organization is our asset. Be a good caretaker. You got to really, so apologize for that, folks. Not sure what happens, but how that's happening. Anyway, that's to the 7 areas where digital automation can help you get some real exponential breakthrough advancements in certain sub-processes, which will enable you in the overall picture to maintain and those productivity annuity requirements. Let's talk about a case study here. There was a client that had launched a e-commerce site to sell some equipment and services. It was operating well, except for one problem. The credit approval was taking 2 weeks. So, a customer goes online, makes an order. I don't want to wait 2 weeks. I want it processed. I want it fulfilled and fast. So here was a case where using Emagia's digital automation, that cycle time was reduced from 2 weeks to 1 to 2 days. Now, earlier we talked about incremental versus exponential. Well, this was exponential improvement. And then what happened? Well, all good things happened after that, right? The traffic to the e-commerce site increased. Customer sat was much higher. So a lot of good things from an exponential leap forward using digital automation. Well, I think the benefits are self-evident. Certainly, first of all, it enhances the experience for your external customers. A lot of cost savings. Staff, bad debt, AR funding. Improve serve internal customers. Meet your SLAs, your internal customers are happy. And it does provide a nice repository on all things AR that can guide operational improvements. And over time, the sequence, improve that customer service, that customer experience, will control the credit risk in this pandemic economy, leads to good things in terms of revenue, profit, and cash flow. All right, so our conclusion. Shared service organizations are in a tough spot. They really have a daunting challenge to deliver improvement every year. And many factors influence that. And many of those factors are obstacles. But in our opinion, in our view, it's unlikely that a shared service operation can meet its demands to deliver sustained improvement without utilizing today's digital automation tools. We just don't see how it's possible. You need to fuse that technology into your operation. Akshay, any questions?
I want to again remind the attendees to please post in your questions to the host in the chat window. John, here's a question that we've got as we were progressing through this session. Why do operating divisions want to retain back office functions like order to cash?
Well, there's 2 reasons. One is kind of the whole control issue, which to me doesn't stand up under rigorous analysis. I mean, they can't do it as well or as cheaply as you can in a shared service order. But the other reason specific to order to cash is the customer facing activities. And a lot of divisions want to hold on to that. And that's understandable because they have the customer context, the product and service knowledge and that sort of thing. So very often customer service is retained at the division. Collections for the larger accounts gets retained, but then collections for the smaller accounts goes into the shared service organization. Even dispute resolution will end up being a collaborative between the shared service center and the operating division. But for functions like application, customer master file update, credit risk management, to me, there's no justification for doing that. And the control of those sub-processes is not essential for the operating division.
Thank you, John. The next question that we have is, does it make sense to try to move as many functions and divisions into SSO?
It does. It does from a productivity or efficiency and an effectiveness standpoint. Because remember this, the shared service organization can take advantage of economies of scale, specialization of labor. You may have a small division where one person does collections, credit, and cash app. Well, not cash app. That's an internal control weakness. But collections, credit, customer master file, maybe payables, and there certainly cannot be experts in all those things. Where if you go to a shared service center, there are experts, specialists. So you get that specialized labor. You can afford higher level management, people with greater expertise, easier to level the workload and to respond to surges of work in one division and balance that versus slow periods in other divisions. So there's a lot of advantage the SSO has that the individual division does not, and it results in better performance.
Thanks, John. I think the next question is something like most of the organizations think about, right? The question is about okay, with the digital automation coming in, like how much of the total work can digital automation perform?
Well, that's a good question, and this is the promise of digital automation, the value. In sub-processes like cash application, digital automation can do 80 to 85% of the manual work. I mean, what a huge leap forward. In credit vetting, it can do 60, 70% of the work. In collections, maybe just half. So there's a number of sub-processes where digital automation can make huge reductions in the labor required, which ultimately has to be achieved in order to deliver those 2, 3, maybe 4% increases in productivity year after year after year.
Thanks a lot, John. I think we're just on the top of the hour over here. Just wanted to thank you very much for spending time. I think we'll take any of the questions if you've got. John, if you're going to move to the next slide, that info@emagia.com, we will be able to respond to all of those questions. And again, a reminder, our next masterclass is 2 weeks away on October 22nd, which is again a Thursday at 10 a.m. Pacific time. And the topic is quite very interesting. It's high touch to high tech, journey to touchless collections. So that's something that we're going to be talking about. So we all look forward to having you there. And until then, have safe weekends and safe fortnight. We look forward to you on 26th of October. Thank you very much, John. You have a good one too.
My pleasure. Thanks, everyone.